And we're live.
All right, let's get into it. Thank you so much for having joining us this interesting edition, of course, of Behind the Markets today, the 24th of February 2023. Glad, of course, for those of us who are able to get us live on social media, great, and happy to know that you're able to find time to be with us today. Mutwale, what do we have today on the table for these wonderful people?
Okay, so today we're going to be going through inflation news. There was that roundup, and then we're also going to be going through something I call on my Futuristic Friday Outlook today. We'll be talking about the future of the capital markets, but we'll also just be going through some of the international data because yesterday there was a lot of CPI data that came out of Europe that was showing that inflation is still rising. Around the world, it looked like it was dunking, but it's now started rising again. So we're going to be assessing that as we're getting into the final part of the first quarter. Remember, I said if you want to build your portfolios, build your wealth, start making your investment decisions now. It is actually time to start doing everything in the first 3 months of the year because that's the momentum builder. It's often very quiet, but it is the best time to start making your investment decisions and your savings decisions and the right decisions. But the reality, Vernon, is this is also the time when everyone decides that I think I've had enough of trying to be responsible. It hasn't worked for me. That's when you get most of those reactions where people effectively just give up. But let's take a look at yesterday. We saw again yesterday a vicious move down in the currency, more than usual, down 0.4%. This has been the highest move of the FX rate. The highest daily move of the FX rate since January 25th. So in the last 30 days, this was a big one. So it was 0.4% up, basically moved about 8 and way upwards. And this is the 99th day. Tomorrow, Monday, Vernon, will mark 100 days of consecutive loss of our currency. 100 days of consecutive loss of our currency. We've seen we have seen it get basically bludgeoned since then. Year to date, the kwacha has lost value. The dollar has gained, by 8.8%. Obviously, the reversal can be said about the kwacha. 4.14% on the month. So we've seen this as steady loss of value. In fact, it's actually picked up pace since the end of January. So the BOZ interventions seem not to be having an effect yet. We'll see later down the line, but it's as it stands, they're not having any effect. In fact, it looks like it's even getting worse. It looks like it's even getting faster. And I think what the BOZ has probably done is stated that they're concerned about the FX rate and therefore confirmed a lot of people's beliefs on what's happening, and therefore speculation is moving in a negative direction. 1.076 is the kwacha versus the rand. The rand is up 0.03%, but year to date only 0.79%. So SA imports are still not in danger. But some news came out of SA yesterday showing that South African PPIs dropped from 13.5% to 12.7%, meaning that which means a monthly deflation of 0.6%. So two things are happening, Vernon. Prices of goods in South Africa in rands are dropping, and the rand is still not that strong. So imports from South Africa are still protected from excessive inflation. So we'll probably see a lot more pickup of imports from South Africa, at least for now, as probably imports from the rest of the world, like Europe, China, is still becoming way too expensive. So the weak rand and the falling inflation of South African factory prices will probably lead to a lot more people importing from South Africa. Taking a look at our bond market yesterday, we did see that bonds are still moving in a steady click, 0.06% up yesterday, and year to date 4.67%. Now, when you combine that, it means that bonds are just edging out inflation at the moment, but a little bit better than last time where bonds got swallowed by inflation. At least this month, they're up 2.39% versus inflation, which is up 1.95%. We'll go through deep inflation data, meaning that the bonds edged out the market by about 0.4%. We had real yield this month of about 0.4% on your secondary market on bonds, meaning that bonds did beat inflation. However, we are also taking a look at how the stock market fared against the stock market has fared this month so far. We're 24 days in with just a few days remaining to go. Stocks yesterday were down 0.65% because of Airtel. Airtel was up 0.55%, but Zanaco was down 4.72%. So that actually pulled down. Remember that Airtel and Zanaco are part of the billion kwacha club. Billion kwacha stocks tend to move the market very easily, and Zanaco being the bigger one than Airtel, being about 4 billion, while Airtel's about 3. That actually is obviously Zanaco. The effects of Zanaco won out. So yesterday we saw the stock market down 0.65%. With a close of 7,213, but on the week it's down 0.65% as well, and on the month it's down 0.18%. So yesterday's drop in Zanaco prices really wiped out the whole month's gains, because we were in a positive position yesterday, and year-to-date losses are 1.69. So the stock market is relatively down compared to the bond market. And as I said, defensive assets are what are going to be the working case. Because if you take a look at your commodities market, your commodities board is showing the same thing. Although yesterday we saw a horrible loss in copper prices, 2.87% dunked down. Wow. Oil prices went up 2.33%, and gold was down 0.16%. So copper is showing that tax revenue will probably be weak. That's going to put a lot of pressure on the lending market from the government, because I remember that they rely also on tax revenue coming in from mining, obviously mainly from domestic payee, but they're not going to get it only from mining. But that does also show, when you see a weak copper price like this, just know that it also triggers low FX inflows, because we're not going to be able to tax them as much on mineral royalties. So in other words, that comes down, and also probably corporations tax starts to come in a bit lower. So indications of first Q inflows are relatively bad, though they were good at the beginning. But year to date now, copper is only up 6%. On the month, it's lost 4% in terms of the price. Now, when you're taking a look at other assets yesterday, Bitcoin and Kwacha up 1.36%, Ether up 2.86%, with gold up 0.23%. Year to date, gold is up 9.15%. But really, that's mainly driven by the impact of the dollar. Gold in dollars is only up 0.24%. But if you're looking at crypto assets, 50.23% is Ethereum, up year to date, with Bitcoin up 57.35 year to date. But remember, I always tell you people this, because somebody is going to quote me wrong. And I keep telling you, crypto, Bitcoin, and gold are not to exceed more than 15% of your portfolio. But people like burning their fingers and then asking you what happened. If you put your hand in the fire, sometimes it goes wrong. Never exceed it. It is what you call wealth insurance. You're seeing a downturn in the stock market, which is performing negatively, and while inflation is highly elevated, you're seeing bonds just only edging out inflation. So when you have when you have gold, Bitcoin, and stuff just sitting at 15%, so for every 100 kwacha you have in savings and invest, that's it, of your savings invested, at most 15, but preferably about 5, anywhere between 5 to 15 kwacha of every 100 saved, you can keep in a mix of those assets. Those ones would counterbalance the slowness of your bonds and the weakness of your equities. That is what we call wealth insurance strategy. I'm going to repeat this over and over. But in fact, whoever's doing our clips for today, make sure you get that part. Okay, make sure you get that 1 minute clip where I've said that, and then rotate that, because that's going to be the issue. But the big news from yesterday, Vernon, was inflation data. So I'm going to give you my firm's inflation report from yesterday. We did pick it up. So here is the inflation data fresh off the press. This is our inflation report for February 2023. Yes, that's a handsome man in that picture right there. Now, taking a look at the main data that we saw, inflation year on year was 9.6% up from January, 9.4%. But monthly inflation is coming in hotter than expected, putting expectations at 11%. The main driver of inflation was that's an error there. Non-food inflation, not food inflation. Non-food inflation, which was mainly driven by transportation costs, and we've seen that food prices are still seeing pressure from grain prices, and also contributory prices from fish and poultry. Okay, we'll go through some of this data now. So if you take a look at the chart here, Vernon, here we're seeing that annual inflation for food inflation was 11.6%, same as last month. So it stayed the same. And we saw that our monthly inflation went from 9.4 to 9.6%. What were the key drivers? Non-food inflation moved from 6.5% to 6.9%. Now, remember that inflation still sitting at about 9.6% is really just base effects. Okay, but once we get past base effects, December is already showing that we're probably in line for 11%. So expect this inflation curve to start picking up, especially because of transportation price pressure. But if you take a look here, and here's the first step I can tell you: February inflation was 1.95%, which was this is monthly. So we use monthly inflation to assess how this has been doing, but it's 2.24 times higher than the 10-year average of February inflation in general. Okay, now the previous month was only 1.95 times higher. So you can see that inflation pressure is building. So it's actually upwards momentum. And this is why the central bank raised rates. This is why the central bank has squeezed has tried to squeeze the has tried to squeeze the reserve ratio. But unfortunately, these factors are not helping because a lot of this is energy price driven. So a lot of these changes have to come into energy price reform. And so you have to keep an eye on the Minister of Energy's proclamations of blending fuel, on his proclamations of making sure that he's cleaned the pipe quickly enough so that we can actually get diesel coming in the finished product, and whether that's going to have less transportation costs and lower inflationary pressure. And I'll show you here. So food inflation, you can see, actually dropped from 2.76% to
Yeah.
1.96%. It's still above expectations of 1.16%, but you can see the gap between reality and expectations has narrowed as in comparison to last month, where we saw it was almost three times the gap. It was 2.5 times the gap, but now you can see that it's much more narrow. It's not even two times the gap. So we can see that food inflation, though elevated, and we are in the inflation hill. Remember that the inflation hill is November going all the way to about April. So that is the higher parts of inflation. Then we go into the inflation valley, which starts somewhere around May. It flattens out, then it goes into a valley somewhere around May, June, and starts to come down. So you can see the inflation valley. If you take a look at that red line, our firm has done a study of inflation over the last 10 years, and those are what we call the expectation points. Okay, what is the average amount of monthly inflation over those months? And that's why we measure this month. And that's why we focus more on monthly inflation than we focus on daily inflation. I mean, on yearly inflation, because we're trying to get rid of base effects. So we use what we call an expectations curve to be able to see it. So you can look very carefully. What you see is with the inflation valley. So if you look at, let's say, March 2022, you can see that red line comes down and then it sinks. And then around September, October, it starts to pick up. So I always tell people, think about inflation as the temperature. If you look at the temperature outside, that's how inflation is supposed to be. If it's rising, you'll often find that inflation is rising. If it's cooling, you'll often find that inflation is cooling. Mainly that's because of food supply. In the colder season, that's when we have excess food. Now, let's take a look at what's actually driving food inflation. For all of you, this is what we call the monthly kitchen table index. Okay, and it looks at all the prices of the different categories of food. And as you can see, for February, grain 7.96%. This is monthly prices. So we still saw a 7.69% increase in grain prices, which is your milli meal, your roller meal, your maize grain prices. They were up about an average of 7.69% versus the previous month, not the previous year. So there's a lot of pressure coming in from the grain market. We also saw, and now this is higher than the last month's price of 4.36%. So these, in as much as we just offloaded a bunch of grain onto the market, it's still not reflecting, and we're seeing higher prices. And I put this very simply, Vernon, you can drop the price of grain and offload more, but also bear in mind that, one, you're also increasing the price of transporting that grain, because that grain doesn't get into the milling plant by magic. It gets there by truck. So there's a cost to it leaving by truck and getting there. And if you increase the cost of trucking the maize to the milling plant, well, I think you've increased the price of mini meal, because then it has to leave the milling plant, go to the storage center, then leave the storage center, go to the shop, then leave the shop and go to your house. And all the way along this grain, you've really much, okay, obviously the house part, that's not that much. But if you leave, if from where the maize is, all the way up to the milling plant, all the way up to the store where the person purchases it, or the stand where they purchase it, you've increased the price of transporting it. So obviously that's going to feed into the cost of the product itself, even if you offload more grain. So you've offset the grain by increasing the transportation costs. Because I think people don't recognize food has to be transported from where it is grown to where it is processed to where it is stored to where it is sold. Okay. So you got four areas where it has to move. So obviously, 7.69% increase in monthly grain prices. Other thing that we saw was meat prices. For all you Chisanyama people, I think you'll probably be celebrating this part. Meat prices is down 1.51. It's down 1.51%. I can see the bright talk. Or are you getting ready, Vernon? Are you whipping out the bright talk this weekend now, knowing that you can add a bit more meat to the price stand?
At
Just a
least,
little.
yeah.
Just a little bit. 1.51% drop in general meat prices this month. However, unfortunately, for those of you brothers who want to put chicken on the price stand, chicken is up 3.41%, but this is much lower than the previous month where it was up 10.22%. So you can see meat is down or slowing down. Fish prices also came down from fish inflation came down from 4.78%. Now, how many brothers put fish on the price stand? I've seen a few, but I also question them. No, it's Friday. I also question them. Who's putting fish
Mm.
on the braai stand? I know that it's a nice thing to grill and
Mhm.
fry, but frying it, okay, yeah, smoked fish, yeah, I'll give them that. That's down 2.23%. Vegetables are down 1.4%. They've actually come down in prices. The vegetable index has shown a drop in prices, while condiments have gone up, mainly driven by charcoal prices. So you can see that if you look at this is the food breakdown. The main pressure is still coming from the grain market. 7.69%. That is what we call our kitchen table index. We put that together and we look at the averages of movements based on the Zamstats bulletin. Now, if you look at the non-food inflation, this is where your inflation this month is coming from. Why did inflation run up? You take a look at the February monthly inflation of 1.14% versus 1.93%. That is a huge spike. It's going against the direction because usually we expect non-food inflation to come down in terms of the monthly non-food inflation rate should be coming down in February, but it's gone up. And last year it was also coming down. So the pressure has really built up. And this is all driven by transportation costs. Rising fuel prices and the pump prices and diesel prices have led to increased transportation costs. And if you want to take a look at that, here you go, Vernon. There's the final hit of it right there. Transportation inflation. Take a look at it right there, smack dab in the middle. 6.7% month on month. Okay. The cost of transportation is up 6.7% versus the previous month when it was only up 2%. Other things that are contributing, obviously, to this are food prices, which are up just under 2%. You're also seeing recreation and culture up 2.2%. Education prices up 2%, and that's down from the 4% of previous, but we're still getting some inflation in education. Restaurant prices still up 1.2%, picking up in price. But the rest of things are just pretty much in line. So the things that are above the line of where inflation was this month of 1.95%, it's things like transportation, recreation, and education. That is where the big ones are coming from. But really, the star of the show here has been transportation. We went for a while, Vernon, of experiencing price hikes in fuel without seeing it translated into the transportation sector. But somewhere towards the end of the year, we saw that stopped. And we started to see now transportation inflation started to pick up. In the beginning of this year, these two consecutive hikes, and mind you, there is a third one coming down the barrel, expected to be another 3%. So expect transportation inflation again to drive inflation upwards. I'm expecting higher than expected March inflation, mainly because of transportation inflation, and we don't have much food output to drive that down. So expect again, people. The purpose of watching such shows and me giving you such data is not for debate rhetoric, because that's what everyone does when and they go into debate club mode on social media. This is for you to know that when you are coming into next month, and when you are seeing this, right, transportation costs are coming up and they're driving most of inflation. It's very important for us to now start planning our month for higher transportation costs as you did this month to do it next month, because it's looking as though there will be another fuel hike, which will translate into transportation costs. So expect fuel prices to be above 28 kwacha at the pump. Expect 19 way up on fuel prices. You'll probably see a little bit higher on diesel prices. That is the expectation. We'll be waiting for that information to come in next week, Tuesday. That's when the ERB is going to give the announcement. But prepare yourself, okay? That is the important part. Prepare yourself. Do not get caught on the back foot. That is inflation data. Now, quickly, Vernon, just before we get into the future of capital and capital markets, on my futuristic Friday thought for today, which is obviously the future of capital and capital markets. Let's take a look at some of the data that came out. Some of the main news that was driving yesterday is that everyone is still fearful of a Federal Reserve rate hike around the world. So that's driving interest rates up. Okay, that's what's also driving interest rates up. There is a fear of the Federal Reserve coming in with a higher than expected rate hike. But we did see yesterday one of the biggest pieces of news that oil prices pushed up by 2.3%, mainly on the fears of Russia cutting supply by 500,000 barrels a day. Remember, Russia is one of the biggest oil exporters right there, and oil producers and oil exporters right there next to OPEC, and that's why this OPEC Plus actually involves Russia. We saw Hong Kong home prices decline and end a 7 month. Sorry, home prices rise, ending a 7 month decline as they rose by 0.6%. That's signs of the Chinese housing price market also starting to pick up. And just a piece of news that came out yesterday, which is actually quite interesting, is China says it sees the potential of Chat GPT like technology. So you remember that thing can actually talk to you and it can guide you. It's a bit worrisome when the Chinese government are saying that. But anyway, that's their choice. The main thing yesterday, obviously, was oil prices coming up. Now, the other part that we also need to start looking at, as I said yesterday, was got to do with data that came out from CPI. There was consumer price data that came out around the world showing that inflation pressure is still rising, Vernon. Now, not just the Zambian inflation read, but just general inflation data is still on the restoring that inflation is still it's not picking up rapidly, but it is still significantly on the rise. Now, looking at yesterday, this is the data that came out yesterday. We did have CPI data coming out of Europe. Monthly CPI was negative, but year-on-year CPI was 5.3%. So we are seeing that Europe, it was sliding down, but now it stopped at about 5.3%. General inflation, sorry, that was core inflation. General inflation was down 0.2 for 0.2%. It deflated versus the deflation of 0.4%, showing a little bit of inflation pressure, while the general CPI is still at 8.6% for Europe. Botswana kept its interest rates exactly the same, 2.65%, because it does see inflation slowing down. GDP quarter four data revisions, revisions that came out of the USA. GDP data was 2.7% versus 2.9% expectations. So quarter four GDP quarter on quarter was 2.7% for the USA. Other data that we are seeing is that oil inventories were up 7.64%. Now, this is significant, Vernon, because if oil inventories go up, but oil prices still went up, that means the fear of Russia is stronger than the US oil inventory buildup. And that is a huge thing, and especially while the rest of commodities are starting to come down. We did see CPI data coming in a bit stronger from Japan, 0.5% versus the previous month of 0.2%, year-on-year inflation of 4.2% versus 4%. So Japan is actually facing quite strong inflation into the economy. So that's the moves there. And we're seeing inflation still being sticky and picking up in various areas of the economy, while we are also seeing industrial still slowing down. That was previous data. Now, going into today's data read, what we should be looking out for, German GDP today, quarter four GDP today is expected to be 1.1% versus 1.4% their year-on-year GDP. We got our inflation read. Italian interest rates on 10-year bonds and 5-year bonds should be coming out to give us an idea. Remember, Italy is the fourth biggest bond market in the world, so that's why we have to pay attention to it. Behind US, China, Europe, there's a lot. US, China, UK. Italy is one of the biggest bond markets. The next thing that we'll also be paying attention to is Brazilian inflation to start seeing what EM inflation is, manufacturing data coming out of Canada to see how industrial growth is still doing. While we'll also be taking a look at oil inventories, at oil rigs, how many oil rigs by the Baker Hughes index that shows us how many oil rigs are online with U.S. news sales. But still, then, in the main picture that we are getting from the market boils down to this: we are having industrial slowdown, growth slowdowns, inflation starting to pick up, even domestically. Inflation still higher than expected. While finally, we're looking at interest rates that are starting to pick up. We saw that in mortgage rates yesterday. And that, Vernon, is our roundup of how markets are doing in the space of just a couple of tens of minutes or 20, 25 minutes. So I think we managed to knock that out. Now, let's get into a discussion on the future of capital markets and what does that mean? What policies? So yesterday, and I think Cecilia covered it. Thank you to her. We did see the coverage of the capital markets master plan. This has actually been handed out. It was opened by the minister. I got it right here, bro. Got it right here. Read them and weep. Read them and weep, people. Read them and weep. But they did say that they're going to make a common man version, a citizens version of it, because this one is for us who are in the sector. And here's some of the goals that they do want to get into. Okay, they've set some goals for what they want the capital markets to be. And the point of the capital markets master plan was to make sure there's political will behind enhancing capital markets. Because, Vernon, there are two ways people get wealthy. They come up with ideas, turn those into businesses, which make them a lot of money, or they take the money that they've made, put it into assets, which turn into a lot of money and give them financial freedom. This is the two ways that people have gotten wealthy in society. Okay, the majority of your millionaires are either people who have saved and invested very well and consistently, or people who have gotten out of debt, saved and invested consistently until they build mountains of money that they can live off more than they can work on, more than they can work for. Okay, so they've gotten that. Or two, people who have built a business that just brings them so much cash that they are able to live off it and they are able to ground it. So either they create an asset from an idea or they create assets from savings and investing. Now, here's the reality, Vernon, that most people don't want to have. Majority of people will not create good enough ideas to create businesses. I'm sorry, this is the reality. Okay, you want to know how that works out? Take a look at the staff to entrepreneur ratio here at Money FM. Okay, there's only a few people who started it, and there's a lot more people who work at it. That's the reality. Okay, your entrepreneurs are not the majority of your society, the minority. So the reality is the rest of society has to learn how to save and invest money in order to do that. And you need a functioning capital market to be able to do that. You also need a functioning capital market also to access developmental funding without begging from people and getting used to begging. So what we have to do is we have to be able to bring in capital into this country without offering people our land for dust. Okay, we do this a lot because we don't have functioning capital markets. People tend to invest in Zambia at very high prices. In other words, they'll say, "Yeah, I'm going to invest in your company, but I'm taking all of it. I'm going to lend you, but I'm lending you at this higher rate," because our capital markets are dysfunctional or they haven't been fully functional. Let me not say dysfunctional. They haven't been fully functional, and as a result, we need to develop them. And you need a good capital markets. For example, if you want to build a power station, instead of trying to negotiate with people, you can issue a green bond. If Zesco was in great shape, they could issue a green bond if they wanted to put up a solar station. Okay, if they wanted to put up hydro, these are things you can do. But if you don't have the functionality of your capital markets and the confidence in it, it becomes harder to do. Countries like Egypt have managed to do it so well, where they have a strong domestic capital market and they built it. So I'll talk about a few things that we talked about there, but I just want to go through some of the main things here. Now, there are some goals that they've set here, or some tangibles that they've set here, and some tactics that they've put out here, which a lot of you who are investing should start to pay attention to, because this will drive what developmental areas are going to happen in your portfolio and what there is political will behind, and what may or may not affect your portfolio. So they have talked about here that they want to move Zambia from a non-rated market or to a frontier market. Now, there's a basis to having a frontier market. Do you have 1 billion kwacha stock? I mean, a US billion-dollar company in your stock market. Um, in fact, you have to have two. In 2014, we did actually. As of the year 2014, Zambia actually did have 2 billion kwacha companies, being ZCCM and Lafarge Cement, before Lafarge tumbled and the FX rate wiped out most of that value. Remember that the Forex rate was 5 back then. The Forex rate back in 2014 was about 5, 6. So when ZCCM was about 5 billion kwacha or so, 5 to 6 billion kwacha. The US dollar price of it was over $1 billion. So ZCCM actually used to be a $1 billion company, but currently now we don't have any $1 billion companies because I think the biggest is CEC with 6.5 billion kwacha. And when you divide that by about 20, if you're being honest here, that's 320 million dollars. So we don't have any $1 billion companies. Now, for you to be a frontier market, you need to have two companies with a valuation of $1.17 billion. Okay, that's actually what one of the experts actually explained, that if you want to do that. So we want to be a frontier market by 2027, and then at least, but by the latest 2021. So in other words, we want two companies to now have valuations of $1 billion, and then there are other factors that come into it. But that's one of the main factors, that you need to at least have two companies with $1 billion valuation in them. Now, we also want the Lusaka Securities Exchange to actually have a market capitalization to GDP ratio of 27% by the end of 2024, which is just next year, people, just next year. So we actually want that market to grow much faster than the economy, and we wanted to have a market capitalization of 33% of the GDP. Now, if you look at some other countries, there was an expert who actually showed us this. If you look at some other countries, it's achievable. And I'm talking about countries like Namibia, countries like South Africa, not that much, but I'm talking about countries like Namibia who have actually achieved quite a strong ratio. Even Egypt that have done that as well. So we want the value of companies listed on our stock market to be 33% of our GDP. So we're looking for our capital markets to at least be somewhere around 150 billion as opposed to the 60 billion, and which half of that is dependent on our listing of ShopRite. We're trying to go from 23 listed companies to 40 listed companies by the end. That's what all of this is pushing. So you can probably see that in order to achieve that, two things have to happen. Either we have to develop a pipeline of companies, three policies have to do this. Either we have to develop a pipeline of companies coming in from small businesses to big businesses. What I mean is that some venture capital pipeline has to move our businesses up, or, and this is the reality, we either have to get government to now start offloading some of its businesses onto the stock market, the way it did with companies like Zanaco. It went through the capital markets. It still owns 25%. The way it's done with Zafico, where it still owns about 60%. The way it's partially done with ZCCM. Now, I know the moment you mention this, every hillbilly politician in Zambia decides to come out and start yelling the word privatization, as if all of them didn't get rich from privatization. Let me tell you something, man. If you look at those privatization committees and you look at the guys flapping their gums about it, they were all on it. All of them were on this stuff. So I'm yet to see any one of them that didn't feature in that whole mix. Okay, and people, there's no issue with privatization. What the issue you have is externalization of wealth. That's what you're trying to avoid. It's not about privatizing wealth. Privatization is the fact that the Fumbeshis and the team own Money FM. That's private. I mean, it's not, they didn't get it from a government. What I'm trying to say is there's nothing wrong with private individuals owning assets. What the issue I think we're trying to avoid is externalization, total externalization of assets. Okay, that's what we're trying to avoid as a country. We're trying to make sure that we have at least a claim to commodities or claim to assets. But we're going to have to see government pulling up a pipeline. And here's what I say to the Zambian people: a bunch of politicians will demonize privatization. And I've said this to you before, Ben. And I think this is one thing we didn't discuss. Um, how to deal with as the capital markets, we need to be conversant about how to deal with the political risk of trying to raise capital. You know why I'm saying this? I'm trying to list especially state-owned enterprise, because unfortunately it's seen as a pariah conversation. Yet, people, I keep saying to you, yet when you go in your day-to-day lives, Vernon, most people pick privately owned companies over publicly owned companies. Most people, when they go shopping, most people, when they use their phone, most people, when they use and buy services, pick privately owned companies over publicly owned companies. And in fact, you've seen some of the some of the companies that the government owns, the ones that are mostly privately owned and the government owns part, you'll see that most of those are doing far better than the ones which the government totally owns, because the government's not good at running businesses. So we have to consider now offloading some of these and making sure that the Zambians participate in share purchases. When a company goes public, do not listen to those people who are going to start telling you, no, no, it's privatization. All those same politicians. I promise you this, Vernon. I promise you this. The same politician who demonizes privatization is going to pick up the phone, call someone like me, okay, if not me, an advisor like me, to ask how they can participate. Then they're going to leave that conversation, go on the news and tell you how privatization is evil, while taking their parliamentary money and political money and shoving it in there, getting rich themselves. I'm telling you, don't fall for these guys. They're tricky characters. Okay, because when you start to look at their own balance sheets, you start to find these very assets that they demonized a long time ago. So don't, like I said, don't fall for these. They're tricky characters. Okay. What I would suggest to most people is, whenever there's IPOs and listings, so this is pushing you that there's gonna be more IPOs and listings. So it's good for people to build up cash reserves to start going into these IPOs. When a company goes public, buy into some of those shares, look at it, but sit down with a financial advisor and see. Build up portfolios, because when Zambia has a listing boom, it actually pushes the economy and pushes the capital markets and creates a lot of wealth. The problem is, last time there was a lack of participation from the Zambians in IPOs, and there was a lack of there was so much growth. The capital markets tripled in size. Okay, in fact, they 10x between 2004 and 20 and 2000. They moved up in huge amounts, but unfortunately, Zambians did not participate in the numbers that they should have. Okay, so if you want to make sure that you want to build your wealth here, take a look at that. IPOs, it does signal. They also are trying to see that domestic share turnover moves from 3.3% of GDP. Sorry, domestic share turnover ratio moves from 3.3% to 11%, improving the liquidity of the market. That's what the expectations are going to be. Implied capital markets, they're looking at, they want to look at capital markets moving from 4 billion kwacha in market capitalization to 23 billion kwacha in market capitalization over the next decade. So they're looking for the markets to grow 10 times. Listen to what I'm saying here, Vernon, 10 times what they are. So there's going to be a wealth expansion. I've said this before, people. Zambia is going to go through one of the greatest wealth expansions it has seen, especially comparable to that 2003 to 2013 era. If you choose not to be part of it, that is on you. You can choose not to be part of it, but then you're going to be the bitter one saying this country doesn't work, because you thought, I'm not for all of this. But then when it was happening, you stood on the sideline. So that's your option.
Yeah.
Evidently, there is political will, and there is actual political muscle and will to ensure that our capital markets basically grow from $4 billion to $23 billion by the end of the decade. Okay. So that means that there's going to be a lot of juice behind it. There's going to be a lot of policy to support that capital growth. There's going to be a lot of lobbying to try and get capital through it. So there's the expectation to basically grow our capital markets or our capital base in this country by 5 times the value. Okay, and that's going to require people, those who are savvy and put their savings in there, are going to be participants of this. There is the expectation also that the first green bond should be launched by the end of 2024, and by the end of 2031, we should see $400 million of green bonds circulating in our system. So for those who are sustainability investors who have gotten past their financial independence, it's time to maybe start looking at what contributions you can make to society, and what you can do with your money that then contributes to the betterment of Zambia. That's what green bonds do. The expectation is also that by 2027, we should have the first exchange traded fund, and then have $50 million of exchange traded funds by 2031, and also real estate investment trusts, which is basically where you pull together real estate and you put that together. The expectations, the first one should be listed by 2027, and we should see $20 million worth of them by the end of 2031. So this is a 10-year capital markets master plan. We've talked about now thinking 10 years, people. This is a developmental plan where all of us are to come in. And the main areas of development they're looking at are enhancing the government bond market and also trying to make sure the government doesn't drain a lot of liquidity out the market, enhancing traditional markets, bringing in innovations in the market, and enhancing capacity building. So they're going to focus on things like investor education, mainly also training SMEs and businesses to understand how to become listable. This is a conversation we were having as well yesterday. So enhancing that amongst regulators and stakeholders as well, and also trying to make sure that they can improve the regulatory framework to make sure that there's confidence in the market. Now there are different committees that have been put. Now, this capital markets plan is basically under the Ministry of Finance, but it's worked together at the Bank of Zambia, Securities and Exchange, Pensions and Insurance. So everybody, this is a comprehensive effort that has been put together. Capital Markets Association, Luce, Zika, everyone is involved in this, of all the main parties. So it's not a single entity that's going to grow the capital markets or your investment markets. It's actually a concerted, all-out effort to do so. Various teams have been put in. I've joined about three of them to make sure that we are. I'm already planning to join about three of them. So they did ask the market players themselves to come in and start participating in the developmental agenda. So those are the goals that you should expect from the capital markets. Massive growth in the market base. Listings should be occurring. We should also be seeing increased liquidity in the market there. So there is going to be policies to try and improve liquidity in the capital markets while also trying to make sure that innovations are brought into the market, such as green bonds. There's a lot of focus, Vernon, on the sustainability bonds. There's a lot of focus on it. In fact, a lot of the presentations really drilled towards that. But in these last 5 minutes, Vernon, I want to talk about the future of the Zambian investor. And there's a part of it I think we didn't talk enough about, but I did bring it up, and I'm going to just bring it back here together. Now, Vernon, according to FinScope, one of the biggest problems of capital markets is or investing in shares, bonds, unit trusts, those products, or any products that will come about. One of the biggest problems people come about or people cite is one, products are confusing, two, products are hard to access. Okay, so the most likely person to invest, because confusion is a problem, we actually studied this market, and this is the basis of even my business model. The most likely person to make an investment decision, Vernon, is one, a person who is tertiary educated. Okay, a person who is tertiary educated, meaning a person with a diploma, a degree, or a master's. Okay, those are your three most likely groups of people. Because education is a barrier to investing in capital markets. It's hard to invest in something you don't understand. It gets confusing. So people don't do it, one, because of confusion. The second reason after confusion is inaccessibility. Now, after a survey was done of savings and investment products in FinScope, it was found that the three most important elements of an asset that for somebody to save their money in, number one is liquidity. Okay, number one is liquidity. Number two, Vernon, is simplicity. Okay, the second factor people are looking for is it liquid? In other words, is it easy to convert to cash? Two, is it simple? Okay, that is the second question people ask. And three, is it accessible? So people are basing their decisions of investment and savings on liquidity, simplicity, accessibility. And I, as a person in this market, I'm going to drive that agenda. And I'm glad to have this document here so I can actually now go into the silos and say, are we making sure that all capital markets products are simple? Okay. Are they liquid? Are they simple? Are they accessible? That's the driving question we need to make sure of. And we need to hold everyone to start saying, everyone, whether you're a service provider, a regulator, a policy maker, are you driving investment products or wealth products to be liquid, simple, and accessible? Because once we do that, we're improving uptake for the Zambian people. So the first target I would see are those people who are tertiary educated, and then it should be simple enough for somebody with an above grade 12 education. Okay. And then you should be able to educate them, and then they're able to start. Now, the second problem they have is technology. So that also the problem also with Vernon, which I had pointed out, was a lot of services of for people to invest in, whether it's unit trusts, stocks, and there has been changes. There's been an app built here. There's been this. The problem for a lot of people is that There are a lot of paper-based processes, and there's a lot of difficult processes in trying to get access to things. There's an inaccessibility of capital markets. So what I actually pointed out is I said, in as much as you want to talk about new and innovative products which should come onto the market, we want to talk about digitization. We need to also talk about digitization of processes, because the Zambian, Vernon, has changed in the last decade. The Zambian is no longer an old person typing and punching away. The Zambian today is an individual who has a smartphone, who has an understanding of the internet. They're becoming more and more educated and more exposed and more interested. 20-year-olds, 30-year-olds are talking about their future and saving and investing for their future. So this is a new generation of people, but they use mobile wallets. They use online banking. They are online. They are on social media. So you need to have digital communication, digitized processes to support digital investment products in order to deliver to those people. And the reason I say this, Vernon, is this. The one statistic they showed was that we have a unit trust market, and I've got it here, mutual funds. Sorry, this is one of the targets I missed. $68 million of mutual funds, which is unit trusts in Zambia. We want to raise that to $250 million. Let me show you where we can get that from. In Zambia today, do you know that Zambian individuals like me and you, Vernon, just me and you, like people like me and you, own $5 billion worth of 5 billion kwacha worth of government bonds? They already own $250 million worth of government bonds. Just Zambian households are holding government bond certificates of $250 million already. Okay, so already the capacity to invest is there. Now, let me just take you past one other point. I took the 2021 labor force survey, and I went through the degree holders, masters holders, and the degree holders, master, and diploma holders, and I broke down what is their monthly income and how many of them are they. Do you know, Vernon? They have a combined earnings of 10 billion kwacha a year. A combined earnings, okay, of 10 billion kwacha a year, showing you that they already have the capacity to inject, even if they're injecting 5% of their income into capital markets or even into unit trusts. If you can get them to put 5%, that is a 50 million kwacha growth every single, sorry, not 50 million. That is a 500 million kwacha growth in the unit trust market every single year. 20 million that you're punching in. It's easy to get this just by getting degree holders, masters holders, and diploma holders to channel 5% of their income into the unit trust market. So it's not that we have to go look outside for all these things. It's here already. On the bond market, we've successfully done it. Why are we failing to do it on the capital markets? That's what we need to start fixing. And that's what me and some of the group of people on this are going to have to fight. I'm amped, I'm psyched. Because now it's time to actually do what we've been talking about. All right, I think that's my roundup that's my future outlook for the day.
Indeed. Thank you so much, Mtwale. Always either time to have you around.
Thank you very much, Vernon. Have a wonderful day and God bless.